recording. All right. Hello, everyone. This is the first finance live stream. By the way, if you find me talking to people in the background, those are just some of my friends. They're in the live stream as well. You can't hear them, but I swear I'm not crazy. But yeah, I might be crazy, but either way. So feel free to send a message if you have any questions. Yeah. But we're going to start off first with exercise 5 from the midterm review 1. And this question is a retirement problem. So we're going to start with it right away. Hopefully my friends learn some finance stuff, and hopefully you guys enjoy the live stream. And once again, I'm sorry YouTube didn't let me stream. Apparently I need to wait a whole day before I can get approved. I don't know why, but that's how it is. All right, so we're starting off exercise 2. Sam Nelson is 30 years old, and next year his annual salary will be $30,000. So we'll take down these notes. So age 30, annual salary of $30,000. All right. And then assuming Sam plans on retiring at when he turns 60, so retirement date is 60, and assuming no inflation and a 10% interest rate of 10%. And remember, our professor said that there was always going to be no inflation on this final exam. Yep, I'll put it up on YouTube after, so don't worry about that. And thanks for chatting. I hope it's okay on Twitch. I know this is not a very normal platform to use for this type of stuff. But yeah, it'll be on YouTube after. But not split up nice and neat how they normally are. All right, so the question that we have is how much will Sam be able to save if he starts saving $2,500 a year when he turns 40 years old? So this is assuming the first payment is when he is 41. And does this amount change if he starts saving when he is 31? And I mean, obviously, yes, he will make more money saving if he starts at 31 versus if he starts saving at 41, just because you're going to save for 10 more years. So you'd have an additional $2,500 in principal, let alone all the interest you'd earn in that 10 years. But we're still going to calculate this out anyway. So first we have savings for year 40. So let's say he starts saving at year 40 and he saves until he is 60 years old. So in order to do this, we're going to do the equals FV, or equals future value. We're going to input the rate. So the interest rate is 10%. And now the number of periods. So in this example, there will be 20 periods, or the day he retires minus the day he begins savings. And remember, he technically begins saving when he's 40, even though he won't make the first payment until he is 41, because we consider all of our future value equations as ordinary annuities. So that's why we have to go from year 40 and not from year 41, even though he's going to make the payment when he is 41. All right, so the payment amount that he's going to be making, and we didn't write this down, but it is going to be $2,500, and the present value will be 0, and we're just going to hit enter on that, and we will get the saving on year 40, and then we'll get the savings on year 30 next. And to do the savings on year 30, we are just going to convert the same equation. We have to get a correct interest rate, though, of 10%. And we're just going to convert the period, or the number of periods, to 30 instead of just 20. And so this will give us the difference. As you can obviously tell, he is able to, oh, the question's up here. Is there a difference between these two numbers? Yes, there's quite a large difference. As you can most likely see, you actually make over triple, or over double, almost triple the amount you would make if you started saving in year 4. However, now we're going to get into the next question, which is that Sam calculates that he will need $25,000 a year for the 30 years of retirement. So he expects to live until he's 90, and he will start saving next year. How much does he need to save annually to meet his objective? And how much would he need to save annually if he starts saving when he's 40? So to begin with, we'll start with calculating how much he needs in 30 years when he retires. So amount needed in 30 years. So the amount needed in 30 years, and that's really long, but is going to be equal to the present value, because we are bringing this value from a 30-year long annuity to a current date. And so that's a present value, not a future value. And the rate of it is going to be the 10%, then the number of periods, which in this case is 30. We just have 30 up there, so we can use it. And then the payment that he's going to need is negative 200, or negative 25,000. So he will need to have in savings in 30 years $235,000 and some change. And so now the question is, how much does he need to save annually to get this much money? And at 2 amounts. So we're going to just write 40 and 30 this time. And what we're going to do is we're going to do the equals payment formula. So once again, the rate is 10%. The number of periods is 60. Well, we can use references. 60 minus 40. And we will use the F4 key to make everything absolute references. If you didn't know this trick, if you're going to pull Excel formulas or copy them into multiple cells, you can hit F4 on your keyboard in order to make the cell that you are referencing an absolute reference, so it'll never move. Then leave all the cells that you want to move with your formula as non-references, so just don't hit F4 on them. So that's the key. All right, so we have the number of periods done, and now we just need the present value, which the present value is 0, but we will get a future value, and that is this $235,000, and we're going to hit F4 on that one as well. So we hit enter, and then we drag down, and now it references both year 60 minus 30, or 30 years of retirement savings, and then in this one it references the other savings. So both of those seem reasonable, but obviously we should definitely check that. So let me pull up the solutions and double check that we got everything right. And it looks like we did. So perfect. And I think we have one more question next, and that is that we need to now redo the problem assuming the nominal rate of 10% and annual inflation of 5%. And actually, we're going to skip this because the professor said that we do not need to know inflation for this test. If anyone does really care and wants to see the inflation, I can go over it. However, it's probably just unnecessary since we were told inflation does not matter. So, does anyone have any questions on exercise 3? I'm going to give a couple seconds. Do either of the two people in the call have any questions? No? You completely understood that? All right, nice, good. Okay. All right. All right. So I guess that means there are no real questions. Once again, if you had questions but you can't answer them just because we're on Twitch, I'm sorry. Feel free to email me. You guys should all know my email, or send me a text. You probably know someone who knows my number. So, all right. So I've already made a video on exercise 3, so we're gonna skip that. Also, it's not on the it's likely not on the exam, and actually most of these are probably not on the exam. Remember, it seems like we're only going to have retirement problems on the exam, so we're going to just focus on retirement problems all day today. So exercise 16 here is another retirement problem. So we're going to do that one. So we'll make a new sheet. And we will have kind of set up formula sheets and stuff like that on the exam, I guess. So you won't have to make it from scratch, but if you know how to make it from scratch, you're even better off. So we're going to start by taking down the info for exercise 16. So we plan to retire in 30 years. Oh, so this one's very similar to the one we did in class, but we're going to do it anyway. So, and then in 20 years, you want to give your daughter a gift. So, gift. And so this will be in 20 years from today, and it's going to be a gift of $50,000. And this is kind of how I kind of like to set up things. I like to put kind of what the thing is, how many years until it's time to do that, and that can be years from today, that can be years from the day that you're going to retire. But the main thing is you just have to make sure you're keeping years in line, and you're valuing everything to the correct to the correct year. You can't compare. Remember, you can never compare money one year to money the next year. It's always different. Money today is not worth the same as money tomorrow, and so that's one of the core concepts of the entire class we've had. And I mean, you guys obviously know that. So now in this next column, I like to put the amount. And so in this case, this is that $50,000 that he's going to be paying to his daughter. So you think you will want $4,000 a month when you retire for 25 years. So the first withdrawal will come 1 month after you retire. So we'll have retirement, and retirement is going to be in 30 years. So I guess we already had that. But now we need to calculate the amount we will need in retirement. So I guess I'll get rid of this. We'll put in the retirement amount. So this is going to be equal to the present value. And once again, whenever we are finding the amount we need at the start of retirement or the start of a period, we're always going to be using the present value. Even though it's not the value today, and that could be a little confusing, it's the present value of our account when we retire in 30 years. So we're going to need $4,000 per month. All right, so first we need the rate. So hold on, let's get rid of this. We're going to get the interest rate here. And the interest rate is 9%, and this is an APR monthly. So no need to convert into an EAR, none of that stuff. So what we're just going to do is present value, the rate, the number of periods. So the number of periods is going to be 25 years, but remember there are going to be 12 months in each period. And off of that 12 months, we're also going to need to divide our APR by 12. Remember, APRs don't need anything fancy when you're dividing them by the number of periods, because APRs are already unaccounting for compounding. So if this was an EAR, you'd have to convert it to an APR before you could put it into this equation and just simply divide by months. Thankfully, apparently we won't have to convert from APR to EAR at any point. I would say that that's nice, but I don't know how much I trust that, and I would still obviously know how to do the EAR calculations, and they're fairly easy, and they are on the sheet, the formula sheet. So they're in the chapter 3, I believe, of the formula sheet. All right, back on track. We need to get $4,000 every month for when we want to retire. So we're going to hit enter. And so in 30 years, we are going to need $467,000. And this is in 20 years, but this is in 30 years, but the gift is in 20 years. So these aren't equal numbers. We can't just add them up. But let's first read question B part B before we go any further. So now assume you want to make annual saving amounts instead to meet your goals. Oh, all right, never mind. So we haven't solved this first part yet. So we have to solve that first. So first we have to do a monthly calculation, monthly payment, and then a yearly payment. So we have two types of payment plans, I guess you could say. But first we have to get what the amount we need in 30 years is going to be. So in order to do that, we're going to do the value at year 30. So this is obviously already the value at year 30. We got that already. So we can just hit and make that equal. Whoops. And then it's a number, so we can't have 4 decimal places. And then the next question is, what is the value of this gift at year 30? So the value of the gift at year 30 equals the future value. So the reason it's future value is because we are able to bring it to the future and to bring it to year 30, not to the past. Now, this rate is a little tricky. I'm not 100% sure if it should be monthly or if it should be annually, but I'm pretty sure we're going to use monthly for this first problem, and then we're going to use annually for the second problem. So we will have to change this between sections A and sections B. So let's get started. We have first the rate, then we have the number of periods. So the number of periods will be the 30 periods minus the 20 periods, and then a payment amount. The payment is 0 and the present value is negative $50,000. So that will mean $118,000. So this is kind of weird because you're essentially saying you're going to make $118,000 less because you paid out this gift to your, who are we paying this to? To our daughter. We're going to make $118,000 less for our retirement. So that doesn't make a whole lot of sense, but that is correct. So we're just going to sum these two together, and we will get the amount we need at year 30 as $358,000. So that's pretty much how much we need to save. And let me actually pull this up real quick to double check that before we get going on to the next part. Otherwise, this will be no good. So it does not say, but whatever. We're gonna try it out. And so for the monthly payments, we're just using payment. We're using the rate divided by 12, the number of periods as 30 times 12, the present value as 0, and the future value as this, or the amount of money we need in 30 years. And then we are going to do the same thing, equals payment. We're going to grab the rate. We're going to grab the number of periods, this time just being 30 because they're yearly. We don't need to multiply anything. And then the future value, just like that. Huh? So I'm just going to go to Council's chat. So this is actually incorrect. So I'm sorry about that, but I guess it's a good learning opportunity because we get to realize that we should, I should have moved these to the value at year 0. Otherwise, this won't work. I did realize that it was probably a little silly to do this in this way, but this needs to be negative. So let's just make that negative, and I believe then everything works out correctly. Yes. No, it doesn't. What? All right, we're off by $2. All right. Value at year 0 is what we need to do instead of doing this. So it won't work this way. So we got to redo it. So the value at year 0 of this retirement account amounts. And actually, we should probably... Oh, I realize why we made a mistake now. It's because we need to convert this to so it needs to be monthly for the first one, divided by 12, times 12 for the first one. All right. Sorry, I thought it would work, and it does work when it's done correctly. But remember how I was saying that for this first section, we need to take everything and we need to bring it to the 12th, or make sure the interest rate, the APR. So APRs need to be adjusted so that they are the monthly rate instead of the yearly rates. So that's how I messed up on this section, but it's okay. So we found that out, and now the monthly payment section is correct. We can copy and paste that as the values, where are values. And then now that we have the monthly payments correct, now we can go back through and we can do it as yearly payments instead of monthly. So we'll do that for all of our formulas here. Just get rid of the divided by 12 and the multiplied by 12, and we should get our yearly amounts that we need. And hopefully that all worked. This is correct. Payment of 4,000. Oh, this one is not correct because we still do need $4,000 every month. But we're just going to need it a little different. All right, so there we go. Now everything is right. All right. That's confusing. I'm sorry I messed up on it, but the problem is you have to keep remembering when months matter, when months don't matter, and don't make that mistake like I did. So yeah. And yep. All right, so we're gonna move on. A little silly, but yeah. We're gonna move on now to the other question that we had, which is hold on, let me pull it up. I think it's here. Modules. So the next thing besides a retirement problem that we have to do is we're going to have to do a capital budgeting problem. And if you remember from, well, you obviously probably remember capital budgeting. We did it for like the entire semester. So we're going to do capital budgeting of ICE, or this restaurant that we had, and I'll open that up right now. So let me pull this open, and feel free to ask any questions in chat. I have it open on the side. So this one's the real simple one we did as one of our first capital budgeting problems, and we're just going to go through it, and then we'll go through a more complicated one later on. However, we've seen quite a few of these already throughout the semester, so we don't really need to worry about that. So, finance manager at fast food restaurant is presented with an opportunity for opening a new location. The company has already paid a consultant $50,000 to complete a demographic study about this new location. So this $50,000 that they pay the consultant is a sunk cost. There's no way they can get this money back, and therefore it should not be considered in our net present value calculations. So we're going to move on then. So the results indicate that this is a good opportunity. However, since it will be close to a new location, there will be a negative tax effect on the after-tax cash flows of that other location by $100,000 per year. So this is cannibalization, and we have a cannibalization effect of $100,000 per year. All right, so there's the cannibalization effect, and that's negative, so we'll just do that. And then the company would use the land they purchased 3 years ago for $100,000. And they estimate that the value of this land is currently worth $125,000. All right, so the book value of the land is $100,000, and the current value of the land is $125,000. So remember that the book value of land does not matter because the land is already owned by us, but the sale price of the land does matter, and we can only claim the income as the gain on the land. So let's go through and do kind of the land calculations right here to begin with. So first we have the book value land, and then the current value land, and then we have the gain on land, and then the tax effect, and we'll put taxes here. We don't know what the taxes are quite yet. We haven't read that far, but we're going to have book value of land, current value of land, gain on land equals the current value minus the book value, so $25,000 gain, and then the $25,000 will be multiplied by negative of whatever the tax rate is, which for right now is 0, and so then we have the NPV, or not the NPV, but the like what we're giving up. So I guess we'll just say the value, and so we're giving up the current value of the land minus the tax effect of the land. I think that's right. So hold on. We're giving up the land, which is $100,000. And we're giving up the opportunity to make $25,000 and the land itself. Huh. All right, hold on. We'll come back to what the value is, but we're gonna keep going. So the land is worth $125,000, and they plan to spend an additional $500,000. So investment is $500,000 on the plant and equipment to make their product. So the equipment will have a 5-year useful life. 5 years, and it will be depreciated to a salvage value of 0. So value 0. So yep, that's pretty much it. We can now calculate depreciation expense. We can just do that really easy. Depreciation equals the investment minus the salvage value divided by the useful life, which we know will be $100,000, but we'll calculate it out anyway just so we are double sure about everything. So we have depreciation on the straight line basis, and the company feels that they are able to sell the following number of meals each year. So now we'll actually get into kind of the cash flow analysis. So first we're going to make the years. These should not be dollars. They should just be regular numbers. 2, 3, 4, 5. So those are the 5 years. Oh, and I guess we have a year 0. So we'll move this over. So year 0. I don't want it to be that. I want it to be whatever. General. No accounting. So we have sales first. Then after sales, we will have we will have cost of goods sold, and we will have gross income, and then we will have SG&A expenses, and we'll get to more stuff later. But first, to calculate gross income, there will obviously be no gross income in year 1 or in year 0, but there will be gross income in a couple more years. So we're going to insert a couple more rows, and we're going to have the cost per meal, and the cost per meal is $25. And the cost of goods sold is 0.45 or 45% of every dollar we make. So now, based on that, we can calculate our how much sales we and cost of goods sold we are going to have. So first of all, sales are going to equal 40,000 in year 1 times $25 per meal. In year 2, it's going to be 60,000 times $25 per meal. Year 3, 80,000 times $25 per meal. Year 4, 90,000 times $25 per meal. And year 5 is $100,000 times $25 per meal. All right. Now, in terms of cost of goods sold, we just take the cost of the meal, we multiply by $45. We hit F4 on the 45% in order to make it an absolute reference, and then we pull all the way across. We also should make this negative since these are costs and they decrease our cash flows. And there we go. So now the gross sales are just the sum of these two numbers put together. So we just pull them across and we make them slightly bigger so that everything can fit. And there we go. So that is our first kind of top line of the gross income. So next, we're going to move on. The company estimates SG&A expenses will cost $600,000 per year. So we'll insert another line for SG and A. And SG&A will be negative 600,000, not percent, but dollars. And we need to add 2 more zeros when we convert from percentages to dollars. SG&A just equals that. Hit F4 to make it an absolute reference and pull all the way across. So that's beautiful. And the net working capital that's required is going to be 10% of next year's sales. So net working capital does start accounting in year 0, even though it's going to be used in year 1. So what we're going to do here is we're just going to do for the net working capital equals the next year times, and actually we're going to take it down right here. Net working capital multiple, we'll call it. So let's say we have a like a 10% that we're required to have for our net working capital of next year's sales. We'll just do equals next year's sales times the net working capital. Hit F4 on net working capital so it doesn't move, and you pull it all the way across. And you can actually pull it all the way across because it doesn't matter. You're gonna need that all the way until year 5, and in year 6 there's actually no networking, or there's no sales, so it'll give you 0. So that's how much net working capital we need, and we'll just copy and paste this over here, or up here I guess is the better term, and we'll paste these. Hold up. Control X. And then we want to paste them as values. So hold on. Control C, Control V, and then paste as values. So we're doing this because the net working capital isn't actually what we need, but we need the change in net working capital. So change in net working capital. So change in net working capital is the change from last year. So $100,000 minus 0. That gives us our change in net working capital for year 1. But for year 2, we need the change, which will be the price from the last year to the next year. So we're just going to pull that all the way across until we get to the very end. And then we get our change in net working capital. And this will go on our bottom row. But we don't need it yet because, remember, net working capital does not go into our actual income statement, but rather goes at the very bottom. So We're not going to put it in yet, but it's nice to have it calculated so we can just copy and paste it when we need to. And I'll just add in the numbers here so that it's nice and easy going forward. All right, SG&A expenses are done. And so we assume at the end of 5 period, they will shut down the location, do expected changing laws, and they will sell the land and equipment for $200,000 at that time. So we need to insert another row, and we have to have sale price of $200,000, and that's in percentage. So we'll just switch that over to dollars and add 2 more zeros to account for that fact. And now we have our new thing. And so with this new one, we're going to need to first take the book value of the property, plant, and equipment. So this is everything that all the book values in year 5 that make up what we're going to be selling. So that includes our equipment, our land, pretty much everything. The problem is that we are depreciating our equipment all the way down to 0 by this point. So we don't need equipment, we don't have a plant, but what we do have is the land. So our book value will be just, no, not that, will be just the book value of the land. So that's that. And then we're going to have the cash value of the land, and then we're going to have that be well, not the cash value of the land, but the cash value of the property, plant, and equipment, and that will be this $200,000 sales price. And we'll insert now 2 more lines here, and we will make them both percentages, and those will be the tax rate and our required rate of return. So required rate of return is 15%, and the tax rate is 21%. And we already used the tax rate up here, but we're just going to move it down here. So in terms of the tax effect from selling the land, we would get this gain of $25,000, but we would only actually get part of it. So the value of the land that we would actually get would be this $25,000 plus the tax effect plus the book value of the land. So the value of the land that we would actually sell would only be this $109,000. So yes. Yep. So 119.75. So we did that, and now the next question is, how do we do it for this next problem? So and this one's going to, all these things are going to go in after our income statement is complete. But next we're going to then have the gain on PPE, PPE, property, plant, and equipment. So that's going to be the $200,000 minus the $100,000, just like last time. We're going to once again get the tax effect on selling this, and I forgot the C. So the tax effect. So the tax effect will just be this $100,000 times the tax rate of 21%, and that should be negative because we're losing that money. Let me pull back up the stream chat, and then we're going to get the value. So the value is going to be that you can do it 2 ways, but this time we're going to do the value as the property, plant, and equipment minus the value of it minus that. So the value of the property, plant, and equipment minus the tax effect gives us the value, and this will be in year 5. So that sounds good. So let's now go on to actually make our income statement and then finish things off. And then hopefully this will give you a great insight into how to do these MPV problems. And you can always ask additional questions after that, but I'm starting to get like a sore throat from talking so much. Maybe I should just drink some more water, but I think I'm going to be done after this, besides going over some just questions you guys all have. So get ready if you want to have or want to ask questions in the chat. Get ready to do that, or if you want me to go over something tonight, do that. Otherwise, we'll wait to stream until tomorrow for the other two types of problems and some other examples. So after SG&A, we're just going to put in our depreciation expense. So the depreciation is just going to be the negative depreciation value, and we're going to pull that all the way across. And once again, I made the mistake of not hitting F4. Always hit F4 when you're referencing a specific cell and you don't want that cell to change as you pull it in any direction. So after that, I think that should be all of the expenses that go into things before taxes every year. So we're going to have our EBIT, or earnings before income tax. So that's just going to be the sum of gross income, SG&A, and depreciation. And if you are careful and you make sure everything is positive and negative where it needs to be, then this works out great. And we'll just add a quick underline there so that we see it's kind of the end of this. After we have the earnings before income tax, then we'll add in the tax. The tax will just be the, hold up. We forgot about one thing. And it makes sense why we forgot about it, because it was the first thing we had, and I had scrolled down since then. But that is cannibalization. So we have to pull cannibalization all the way down here, and we have to get the cannibalization. And I forgot to hit F4, but there we go. So there is cannibalization. And let's get rid of all these zeros. They just make things a little bit confusing. And so now we have the correct amount. So once again, take the sum of all that, and boom, there we go. So that's our earnings before income tax, and now we're just going to do the earnings before income tax times negative tax rate, boom, and hit enter, and there we go. Once again, make sure you're hitting F4 to absolute reference cells where you have want to keep them as the same thing. And so there we go. There's our taxes that we're going to have to pay. And once again, taxes can be positive. These are interest tax, or these are tax shields. So essentially this loss that we're going to have in this segment of the business will offset some of the taxes from another section of the business. And so that's why our tax is positive in this place. So if ever you see a positive tax, do not freak out. It is completely okay. So then going off of, pizza, great game. All right. And then, then going off the tax rate, we will have, Pizza was in the chat with me, but he has since left. I didn't realize that. So never mind. He's betrayed me. But after we got the tax effect, we have to add back depreciation. Don't forget to do this. So what you can do is you can just go back up to depreciation and make it negative. Otherwise, what I'll just do is do depreciation and hit F4 because we had depreciation as negative or as positive up here. We made it negative there, but then positive here. So then taxes, depreciation, and what else do we need? Yes, we are allowed to use Excel on the exam. So thanks for the question, Sam. So next we have the actual net income. All right, and we just do equal sum of earnings before interest, or before income tax, the tax, and the depreciation, and we'll pull that all the way across. And that should be everything from our supposed income statement. We'll make a line there. And now we will just add in our next thing. So we're going to have net working capital, investment, and our opportunity cost of the land. So first of all, net working capital, we already calculated that earlier. This is just the change in net working capital we're going to use. So Control V, and remember we need to just paste these as values. So there we go. So there's our changes in net working capital. And for some reason, they are all positive, and that is not correct. So that, I mean, they are correct, but we need to make them the other way around. So it should be 0 minus 100,000, and then this should be 150,000 minus 100,000, and then you pull it all the way across. So hold on, no. This minus this. Boom. There we go. Now it's all correct. And we have it right. So now we'll copy it over, and the net working capitals will be correct. Sorry about that from earlier. I'm a little tired today, but I guess it's no excuse. But now we have everything correct. So that's our net working capital. Our investment was the $500,000, and obviously the investment is negative. We're paying that out at the very beginning. And then finally, we have the opportunity of cost of the land. So opportunity cost of the land in year 1 is the $119,000, and then the opportunity cost of the land in year 5, which isn't really the opportunity cost, so I should probably name it something else, but it's going to be the return that we're going to have on our land in those 5 years or after that. And so then what we are going to get is just our cash flows. So this is the final kind of layer. We have cash flows. Take the sum of all this, pull it all the way across, and there we have cash flows. But we missed one layer. Whoops. We have to do the equals sum of all 4 of these layers, not just all those 3, and pull it across. So is that correct now? Yes, that is. All right, beautiful. So these are our cash flows, and we're going to actually make them all cash then, just because it's kind of silly that they are not cash. And so there we go. And this doesn't really look right. Oh wait, yeah, it does. Never mind. I was being silly. It does look right. Now all we need to do is get our NPV and IRRs. So NPV equals NPV. We'll grab the rate, which is our required rate of return, and then we'll just select all of our values. But wait, not our first value, just our values in years 1 through 5. And then we will just add our value in year 1. Because remember, NPV assumes that you start at year 1, and it discounts all of the cash flows, not just the. It does not have the first one. So the NPV is positive, but is it right? That is the question. It is not. And the question is, why is it not right? Somehow our taxes are off, and so is our pre-tax earnings. What is up? I'm confused. How did I... Where... This should be $100,000 larger. Where did that go? So the cannibalization is not included. Oh, all right. So hold up. This $100,000, we put it in the wrong spot. Or I put it in the wrong spot. Y'all probably put it in the right spot. I just did not. So what we're going to do is we'll just Control X this row and Control V. And there we go. And we'll delete that. And now we'll just redo this stuff without it. So gross income is just these three. All right. So there we go. And now we have the taxes on this. Those are correct. Cannibalization numbers are correct now as well. The depreciation added back, and the MPV. So once again, be very careful. Read to make sure. And why did I make this mistake? Well, for one main reason. I thought that this cannibalization should be included before tax. However, as it says this is an effect on the after-tax cash flow. So we do not get to count that up here, and that's what threw our NPV problem off. Our IRR, however, we're just going to do that now, hit enter, and we're going to get 17%. It's probably not exactly 17%. Yep, there are some decimals, 17.19%, and that'll give us our IRR and our NPV. So what did we learn today? Well, I guess what did I learn today? I mainly learned that you have to remember to take advantage of after-tax cash flows. Don't make the mistake like I made and put the cannibalization before taxes, because that is not going to work. You're going to get that wrong. But hopefully you guys all got some value out of this. I promised I would upload it to YouTube. I will keep my promise, and hopefully you all enjoyed, and hopefully you decide to show up to the next finance review session as well. If not, my feelings won't be hurt. I did make a couple mistakes today. I did correct them, so hopefully you can forgive me, but yeah, that's that. Going forward, I'm just going to, we could do one more thing, which would be we could compute how many meals we need to sell every year in order to break even or make the NPV 0. But we're not going to do that because we didn't really set up our equation to do that correctly. And if you need to see an example of that, here I'll go to my channel and we will come on over to, hold on, let's find the video. Well, actually, we already did this problem. I did it correctly once before. So if you want to review the problem, go do that. But I believe it's right here in this one where at the end we go back through and we find the number of units using goal seek. And yeah, so I would recommend going through and doing the Nature Mountain DCF, watching that video if you need to learn goal seek. And maybe if we have time tomorrow and I'm feeling up to it, we'll do that on that day as well. But hopefully you enjoyed today's kind of live stream, and I'll see you all later. Bye.